Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linn & Associates with your metals market update for this Tuesday, the 25th of April, 2017. Time right now about 2:05 p.m. Central Daylight Time. You know, I was looking at the marketplace trying to figure out what's going on as you are, and it's pretty simple. You got the French elections that have gone into a zone where the public is already anticipating the end of it, and the financial markets that it will be a positive outcome and that France will end up staying within the European zone. We then look at the market, and the market is paying literally no real attention to North Korea. Otherwise, your metal markets would be higher. They don't think that's important. They are looking at the fact that President Trump tomorrow is going to be talking tax reductions. The market likes that. Market is up. What else is the market looking at? It's looking at earnings today. And instead of earnings being weak, they were stellar, off the wall, be it Caterpillar, McDonald's, Eli Lilly, Alcoa. I can go on, but they just came in with big-time numbers, added fuel to the fire. So it's put a bit of pressure on the dollar. It takes the risk premium at that point out of the market. I mean, you couldn't have more risk than North Korea and the U.S. doing this war of words and all these naval ships there, and gold's not rallying on it. I don't care what you think of me, but that's what's going on. Bonds and notes taking out risk premium, and the yen taking out risk premium. So you've got a risk what? Off environment. People are saying to themselves, okay, I'm willing to take the risk. I guess you'd call that the risk on, right? You'd be buying gold if you said, oh my God, the world's going to end. People want to take the financial markets, and that's where they're at. And in the process, you're getting that pullback in the metal markets. Now, is that bad for gold? Well, I'll let you decide on the chart. The chart's got a pattern of a higher high, a lower low. It is over both the 18-day average of 18-week average of closes and the 100. There's nothing bearish there. The momentum is up, and the market's in a pullback mode as a chartist. When you go to a daily area chart of closes, the market is now going from 1294.10 to today's close, and today's close around 1267.10. Remember, because I'm doing this at 2:05, you don't see the settlement price until 4 p.m. Central Daylight Time, but it's around the 1267 level. And it's been as low as 1262.80. As we look at this chart, you can see the high point that the market made, and that's the high point of the year. So now we're in a pullback. Could support be in this general band right here that I'm pointing to? It's one area. If we look at the swing line study, we have a lower low and clearly a higher high. So we don't have a trend on the swing line study. Now, this was a trend in an upside, if you look at it right here. You had higher lows, higher highs. That is not what you any longer have in the chart. Okay, so I'm going to call that trendless. The market is fighting at what I said yesterday, the 18-day average and the 200-day in gray. That's what this deep gray line is. The first times you're over a 200-day average, it is absolutely not uncommon to stay over it a bit and then come back. Then it comes back again often to say, okay, am I really seeing a big change? Why? The 200-day average is almost a one-year average if you take it into account. That's a long time, buddy. So right now we're seeing a combination where the market was over it, it's found some support. If it gets much under it, it'll become a resistance factor for a little bit. What about the Bollinger Bands? They're not in play right now. Why do I say that? Well, 1301.70 is fairly far away from where you're at right now. It's $35, and 1237.20 is another $30. Why get involved in either of that? So I don't think that's what's moving the market. Momentum is. And if you believe, as I do, that momentum leads price most of the time, certainly not all the time, but most of the time, the momentum is turning down. But here's the good news. the market is about to leave its overbought status the way that I interpret it. Any reading under 70 with both numbers is no longer overbought. Now, when a market's up like it was back here and embedded or trying to embed, and the market had both numbers over 80 and eventually the red line turns down, it's a sign prices want to retreat to the 18-day average of closes most of the time. Certainly not all of the time. Most of the time if you had embedded readings. And you'll see that over and over as both numbers were over that and then they corrected. I don't think this is all that bad of action is what I'm saying. In the gold-silver ratio, silver is still losing out to gold. And I pointed that out recently. And when we were down here, I said, if you can't make an immediate run under this, watch out. This market might come up. Frankly, I didn't think it was going to clear these highs that easily, but it did. Therefore, gold is still stronger. When we get to the silver market, the number I've been pointing out recently is that if the Bollinger Band couldn't hold, and it has not held, it might take the 100-day average to offer another layer of support. Let's call that number 1747. I don't think I'm far off on that. Let's see what happens here. Now, you have an outside day down in silver. As a bear, you're cheering this market on. It is under the Bollinger Band, so therefore your odds of it staying under there is now about 4% for tomorrow because the first day it's under it. I use a rule of 5 in that it generally doesn't go more than 5, and if it's 5% of the time, I take one of those percentage points away from that 5% of the time it'll trade above or below the bands. The market's oversold. So I don't think it's terrible. And if today's high of 1805 is taken out tomorrow or the day after, I will label this as too much to the downside, a trap. Wouldn't be surprised to get back to that 18-day average in short order. The copper market has laid down as an oversold market and it is correcting. You know what I'm going to tell you. First layer of resistance, most likely, doesn't have to be, the 18-day average of close in red. And if it gets through there, the 100-day average. So I've got 2 layers of resistance until the market clears over 260, 250. It is still a bear market, lower highs, lower lows, prices under the 18-day average, but oversold, and momentum is trying to lead the price a bit higher to get rid of that. In the platinum market, you are in a downtrend. You have lower highs, lower lows. The 18-day average of closes, the red line, is still under the 100. You still have a bearish configuration there. Prices under it. Momentum pointing down. No reason why the market might not make a run for that 980, 180. Let's assume it doesn't and goes up. 2 levels of resistance at the 18 and the 100-day average of closes are facing it. And to negate the downtrend on this formation, you have to take out 986, that most recent high. The palladium is flip-flopping on it, and this so often happens in platinum and palladium. Should the market take out yesterday's high, if I think it's let's see what it is, we can tell you right now, 800.10. You would then have a pattern of higher lows, and would you have a higher high? Nah. Still wouldn't. You'd have the higher lows, but you got the lower high. So until this number is taken out, and that's why you got to look at these numbers so hard, 805.35, you still have a bearish configuration. Where's the resistance if you bounced up off a Bollinger Band? The 18-day average. Where's the support if you hit an upper Bollinger Band and you often fall back? The 18-day average. It's back into its neutral status. The dollar index is now got 2 days in a row under the lower Bollinger Band. If you believe in the theory that I do, that Bollinger Bands, in fact, this is math, this is not theory, only 5% of the time will the market trade out of the bands. You've pushed the band. Can you keep pushing it, or is the market going to snap back in? You are oversold as this is all happening as well. There's no reason to be bullish at all. And there's still the downside momentum left in this market. So the bears still rule the day. It's really how I'm reading the marketplace. We'll have to see what happens. And I'm still watching where the settlements are going to come in here. Now, you know, I talk indicators all the time. And our good friends at Modern Trader put together volumes 1 and 2 of technical indicators. We want to send you them both out as PDFs. You'll talk Elliott wave, time relationships. There'll be a great options primer in there. To get it, you can either call us at this number. You can go to our website. You see it across the bottom of the page. A great way to get it is underneath this whole video on some websites. It's going to say click here. That brings you right to the form, as does clicking up this icon you're seeing right here. If you're watching me on a YouTube video, that'll bring up the form. Choose what you want. We'll take it the rest of the way. With that, I'm Ira Epstein. You have yourself a great trading day, and I'll see you tomorrow.